Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, we talk about the stock market all the time, but have you ever stopped to wonder where it actually came from? Well, I can tell you it wasn't born in some glass skyscraper on Wall Street. Nope. The real story starts over 400 years ago, and it's full of dangerous sea voyages, mountains of spices, and one truly revolutionary idea that changed, well, pretty much everything. Okay, so I want you to picture this. It's 1602. You're in Amsterdam, which is basically the buzzing center of the universe for global trade. And on this one narrow, quiet little street called Ness, inside the house of a guy named Dirk van Oos, a meeting is happening. And this meeting, it's about to lay the foundation for modern capitalism. It all started with a very big and a very, very expensive problem. So back in the 1600s, spices, we're talking pepper, cloves, nutmeg, they were basically like gold, maybe even better than gold. But getting them, whoa, that was incredibly risky. A single trip to Asia could take years. Your ship could get swallowed by a storm, attacked by pirates, or the crew could get wiped out by disease. I mean, on one of the first expeditions, only 87 crew members out of 240 made it back alive. So trying to fund one of these trips was just a massive, massive gamble. To solve this huge problem, the Dutch came up with a truly brilliant plan. They figured, hey, instead of competing with each other, let's just merge all our little trading companies into one giant corporation. And that's how the Dutch East India Company, or the VOC, was born. Now, to get the money to run this thing, they invented something we're all familiar with today, the initial public offering, or IPO. And here's where the genius of the idea really shines. See, before the VOC, you'd invest in a single voyage. If that one ship sank, well, that's it. Your money is at the bottom of the ocean. Gone. But the VOC model completely changed the game. Suddenly, you weren't investing in one ship. You were investing in the entire company and its whole fleet. So if one ship went down, it was okay. Others could still make it back loaded with profitable cargo. It was literally the birth of modern risk management. So what exactly is an IPO? Well, it's pretty simple. It's just the first time a private company offers up pieces of itself, its shares, for sale to the general public. And the VOC's fundraising effort back in 1602, that was the world's very first IPO. And you know what? It wasn't just an event for the super rich. And this is what's so cool about it. This new idea was surprisingly democratic. I mean, look at this list. The very first shareholders were a true cross-section of Amsterdam. Sure, you had lawyers and shopkeepers, but you also had carpenters, bakers, and, get this, even 7 of Dirk van Oos's own housemaids who pooled all their savings to buy a tiny piece of this incredible global adventure. And altogether, these 1,143 ordinary people raised an absolutely astonishing 3.6 million guilders. To put that into perspective for you, a few hundred guilders could buy you a small house in the middle of Amsterdam back then. This was a fortune, and it was the launchpad for one of the most powerful corporations in history. But, okay, raising the money, that was only step one. The next great innovation was figuring out what happened after people bought these shares. See, they started to realize, hey, I don't have to hold on to this piece of paper forever. What if I could sell it to someone else? And what you're looking at here, this is it. This is the oldest share certificate in the world. It's basically just a receipt, your proof of ownership. Then, on March 3rd, 1603, a man named Jan Allert Sens sold his shares to a woman named Maria van Egmont. That right there, that was the first secondary market trade in history. It was the moment the stock market as we know it was born. So where did these historic first trades happen? Not in some fancy grand building? Nope. It happened right here, on a bridge, right in the middle of Amsterdam. People would just gather on the Nieuwe Brug, the new bridge, and start haggling over prices, striking deals. And if it was raining, they'd just duck into a nearby shop to finish the trade. All right, so let's say you're one of these early investors, and the company is doing great. How do you get your piece of the profits? You'd probably assume they just paid you in cash, right? Well, the reality was a whole lot more fragrant. Turns out, in the early days, they didn't pay dividends in money at all. This old VOC ledger from 1635 shows that they paid shareholders in the very goods the company was trading. You literally got bags of cloves and pepper. Then it was up to you to go sell the spices yourself. Fun fact, one time they paid out so much pepper that the price of it crashed all across Amsterdam.
Eventually, I think everyone agreed that trading in the rain on a windy bridge was getting a little old. So in 1611, the city built the world's first building dedicated to stock trading. And how perfect is this? They built it right over a canal so the ships loaded with spices could literally sail right underneath it on their way to the warehouses. Now, an idea this powerful, a public company with shares that anyone could buy and sell, it couldn't just stay in Amsterdam. One historian described its spread across the globe like molten cheese, slowly and irreversibly. The next logical stop was London. By the late 1600s, the financial center of gravity had shifted to the city's famous coffee houses. Places like Jonathan's Coffee House weren't just for getting a caffeine fix. They were these buzzing hubs of information where news from the ships would arrive first. And in that caffeine-fueled chaos, deals were struck and London's financial market was born. But, of course, this brand new market wasn't all smooth sailing. There were rogue brokers and all kinds of fraud. So to crack down, the British government brought in new rules in 1697. And if you got caught breaking them, the punishment was intense and very public. You'd be locked in a pillory for 3 days, right out in the open, at the mercy of a very angry crowd. From there, the idea hopped across the Atlantic to a young America. In 1792, a group of 24 brokers met up under a buttonwood tree on a street named after an old Dutch wall, Wall Street. The agreement they signed that day, basically promising to only trade with each other and charge a set commission, was the disciplined, humble beginning of what would one day become the New York Stock Exchange. But the journey still wasn't over. From Europe and America, the concept finally made its way east, coming full circle and completing its global tour. And things started happening fast. The adoption across Asia just exploded, and it often mirrored what had happened in Europe. In 1875, Mumbai established the whole continent's first stock exchange, moving traders from under the banyan trees into an actual building. Just 3 years after that, Tokyo followed. And from there, it just kept spreading. Jakarta opened the first exchange in Southeast Asia in 1912, and Manila set up its market in 1927. The financial revolution had officially gone global. And that brings us right up to today. When you look at a chart of Asian stock markets from the last few decades, what do you see? You see the same patterns, the booms and the busts, the crises and the rallies. The technology is completely different, sure, but that fundamental rhythm of the market, those ups and downs, it's a constant echo of its 400-year-old past. You know, financial historian Herald van der Linde summed it up perfectly with this quote. He said, "The plumbing and psychology of stock markets have not really changed over the centuries." And he's right. Despite all the changes and all the crises, the basic mechanics and, more importantly, the basic human emotions of greed and fear that drive everything, they've stayed remarkably the same. Which really leaves us with one final thought to chew on. Think about it. We've gone from a quiet meeting in a house in Amsterdam to the high-speed digital trading of today. The tools are worlds apart, but that core idea of shared risk and shared reward, it's exactly the same. So when you look at the markets buzzing away today, ask yourself, what's really changed in 400 years? And maybe the more important question is, what hasn't? So when you think of the stock market, you probably picture this huge, complex digital machine, right? But the thing is, its origin story is, well, it's a lot more chaotic and adventurous than you might think. We're going to jump back in time to uncover how a wild, high-stakes gamble completely changed the world. It all starts right here. I mean, look at this place. It's a quiet, kind of sleepy-looking alley in 17th century Amsterdam. It's called Ness, and it's almost impossible to believe, but on a single night in April of 1602, inside one of these houses, the entire concept of global capitalism was essentially born. So how in the world does that happen? How does a little back alley become the launch pad for the entire modern economy? Well, to get that, you have to understand the enormous life-or-death problem that the Dutch were desperately trying to solve. See, before there was a stock market, there was the spice trade. And back then, spices like nutmeg, cloves, and pepper, they were literally worth more than their weight in gold. But getting your hands on them, that was one of the riskiest gambles on the planet. Just take a look at this map. This shows the brutal, multi-year journey from Amsterdam all the way over to Java. We're talking storms, we're talking pirates, disease, not to mention running into rival navies. The very first Dutch expedition that tried this set sail in 1595. And yeah, it proved the route was possible, but it came at an absolutely staggering cost. 64%. Just let that number sink in. That's how many crew members on that first expedition never, ever made it back home. Scurvy alone killed dozens of men at a single stop, a place that to this day is known as the Dutch graveyard. The human cost was just insane, and the financial risk was right there with it.
The way they used to fund these voyages was through something called a for-company. Basically, a bunch of rich guys would get together and pool their money for one single trip. If the ship came back loaded with spices, boom, they were all rich. But if that one ship went down, they lost every single guilder. It was a classic case of putting all your eggs in one very, very leaky basket.
Okay, so all these competing little companies constantly fighting with each other, plus this insane level of risk, it just wasn't working. So the Dutch government had to step in, and they came up with a pretty radical plan. They were going to create a whole new kind of company. And on that day, the government basically forced all those small rival companies to merge into one single government-backed megacorporation, the Verenigde Oost-Indische Company, or VOC for short. And to raise a totally unprecedented amount of money, they did something nobody had ever done before. They launched the world's very first initial public offering, or IPO. The idea was simple, but it was absolutely revolutionary. Instead of just a handful of wealthy merchants funding everything, the VOC decided to sell tiny little pieces of ownership, we call them shares, to anyone in the general public who wanted to buy in. And this is the part that's truly amazing. Just look at who bought in. It wasn't just the rich elite. Over 1,000 people invested. We're talking lawyers, sure, but also carpenters, bakers, shopkeepers, even 7 housemaids pooled all their savings to buy a piece of the action. This was finance for the people, for the very first time. Now, the VOC had 2 genius ideas baked right into its DNA. First, it was a permanent company. It wasn't just for one trip. It was built to last. And second, by funding dozens of ships at once, it spread out the risk. So if one ship sank, it was a bummer for sure, but it wasn't a total catastrophe for investors. And those 2 principles, they became the bedrock of every modern corporation you see today. So you've got all these bakers and carpenters who now own a piece of the VOC. This created a whole new question. What can you actually do with these paper shares? And the answer they came up with created something totally new, the secondary market. People just started gathering right here on this bridge in Amsterdam called the Nieuwe Brug, and it was completely informal. They'd just stand around, haggle over a price for their VOC shares, and when they agreed, they'd walk over to the company's main office to make the transfer official. This windy, rainy bridge was, believe it or not, the world's very first stock exchange. And those early days were, well, they were messy. When the VOC finally paid out its first dividend after making everyone wait 8 years, it wasn't in cash. No, shareholders were given actual bags of spices, which, as you can imagine, led to a hilarious crash course in supply and demand, because so much pepper suddenly hit the streets that the price just tanked across the whole city. Yeah, they switched to cash dividends pretty quickly after that. And you know, even the complicated stuff we see in finance today started back then. There was this one investor, Isaac Lemaire, who started betting against the company. He'd sell shares he didn't even own, hoping a ship would sink so he could buy them back cheaper. This whole practice, going short, caused a huge scandal and was banned. Sound familiar? Today, it's a standard and still pretty controversial trading strategy. Eventually, everyone got tired of trading stocks in the wind and the rain. So in 1611, the city of Amsterdam built this incredible structure, the world's first building designed specifically to be a stock exchange. It had a courtyard for trading goods and special pillars where you'd go to trade stocks. The idea wasn't just some informal gathering on a bridge anymore. It was now a real, legitimate institution. And from this one building in Amsterdam, this incredibly powerful financial technology, born on a bridge really, it just started to spread like wildfire all across the globe. From Amsterdam, the idea was just unstoppable. London got its own formal exchange in 1773. Over in New York, brokers famously met under a buttonwood tree and made their exchange official in 1817. Then you have Mumbai in 1875, and after being closed for a long time, Shanghai reopened its exchange in 1990. It truly became a global thing. And what's cool is how each culture made the idea its own. In London, if you were a rogue broker, you could actually get locked up in a pillory as punishment. In Mumbai, the first traders met under banyan trees. In Shanghai, the first list of stocks was just a piece of paper nailed to a wall.
The core idea was the same, but the flavor was always local. So what started as a clever way to pay for dangerous spice voyages grew into the massive, complex financial system that we all know today. It's a 400-year story about how we manage risk, how we chase rewards, and really, it's a testament to human ingenuity, sometimes for better, and yeah, sometimes for worse. It really makes you wonder, what's the next big financial revolution going to look like?
So what really drives the stock market? It's a question that fills endless hours of financial news, right? But honestly, it often just leaves us more confused. Today, we're going to cut through all that noise. We're going to build one single, powerful mental model to really understand how the market machine works. And our journey, you'll see, starts somewhere you'd probably never expect.
Our story kicks off not on Wall Street, but in Jakarta, all the way back in 1990. Just imagine stepping off a plane into that wall of heat and smell. That was my very first taste of Asia, and I had absolutely no idea it was the first step on a path that would lead me straight into the heart of the financial world.
Okay, fast forward 4 years. That same clueless backpacker, now with a fresh economics degree, but let's be honest, zero real-world finance knowledge, somehow, someway, lands a job as a junior stock analyst. You want to talk about a learning curve? It wasn't just steep, it was basically vertical.
And what a world it was. You got to picture this. This was pre-internet, pre-algorithms. The trading floor was just this chaotic symphony of people shouting orders. You had the constant hum of a sputtering fax machine spitting out research reports, and these intense 7:30 a.m. morning meetings that basically decided the entire day. It was raw, it was manual, and it taught me everything.
Because being right there, at ground zero, I realized pretty quick that most of what we all hear about the market, well, it's based on some pretty fundamental myths. So today, we're going to bust them, one by one.
Let's start with the biggest myth of them all. This is the one you hear constantly on the news. Is the stock market basically a report card for the economy? You know, if the market's up, does that mean everything's great?
The answer, plain and simple, is a big, fat no. It's one of the most persistent misunderstandings in all of finance, and let me tell you exactly why.
Okay, so it really boils down to two things. First, the real economy. You know, your local restaurant, the corner shop, those businesses aren't listed on the stock market. And second, the companies that are listed are often massive global giants. Think about Taiwan's stock market. It's dominated by tech firms, whose profits depend on how many phones are being sold in America, not on what the local economy in Taipei is doing. All right, let's move on to myth number 2. We've all been there, right? We love a product, maybe a phone or a new pair of sneakers, and we think, hey, I should totally buy that company's stock. But that's confusing the company with the stock itself, and they are two very, very different things.
So what is a stock, really? Well, put simply, it's a legal right to a piece of a company's future profits. That's the key word, future. You aren't going their buildings or their brand, you are buying a claim on the money they expect to make down the road. And believe it or not, this idea goes way, way back to 1602 with the Dutch East India Company. See, before them, you'd invest in a single ship's voyage, and if that ship sank, well, you lost everything. The absolute genius of the VOC was selling shares in the entire company, a claim on the profits from all the voyages. So investors stopped betting on one single ship and started betting on the company's long-term success. And that's the core concept we still use today.
And that brings us to our third and final myth. And this one's about the market's quiet, kind of intimidating older sibling, the bond market. Most people just ignore it. But let me tell you, they do that at their own peril.
I love this quote from political strategist James Carville. It just captures the hidden power of the bond market perfectly. It's bigger, it's more powerful than the stock market, and it quietly dictates the terms for pretty much everyone else.
So how does it intimidate stocks? Well, let me try what I call the sushi analogy. Think about it. Fresh sushi sells for full price in the morning, but by the evening, it's heavily discounted, right? Because its future value is declining. A company's future profits work the exact same way. $1 of profit 10 years from now is worth less than $1 today, and it's the bond market that sets the size of that discount.
Now that sushi discount isn't just a theory, it's a real number. We call it the 10-year U.S. bond yield. And for decades, that rate has been falling from around 12% all the way down to 0.5%. A lower discount rate means future profits are worth more in today's money, which has acted like this massive 30-year tailwind for the stock market.
Okay, so we've busted the myths. Now let's pull all these ideas together into one simple but really powerful framework that explains how it all fits. I call it the Great Tug of War.
Forget all the complex charts and the jargon for a minute.
Just picture a simple, old-fashioned tug-of-war. On each side of the rope, there's a really powerful team, and they're constantly pulling against each other.
On one side, you have team corporate profits. When companies are making more money, they pull the market up. On the other side, you have team discount rates, and they're set by the bond market. When those rates go up, future profits are worth less, and so they pull the market down. That's it. That is the entire game.
Let's test it out. Think back to 2020. The economy was in a free fall, right? Profits were way down, and yet the stock market roared back. Why? Well, because central banks forced bond yields to historic lows. The discount rate team basically just let go of their end of the rope, which allowed the weaker profits team to easily win the tug-of-war.
So how can we tell which side is winning this tug-of-war at any given time? Well, a really handy shortcut is the price-to-earnings, or PE ratio. It basically tells you how expensive stock prices are compared to company profits. Generally, a lower number means the profits team has a stronger pull for the price you're paying.
And valuations can be wildly different all over the world. Markets like India, for example, have historically had much higher PE ratios than markets like Korea. This usually reflects different expectations about future profit growth or stability, and it gives you a quick snapshot of how investors are feeling in each country.
So, once you understand this whole framework, what do? Well, it means you can stop being scared of the market's randomness and start thinking smarter about how to manage risk, just like those original stock market investors did way back in the 1600s.
See, the goal isn't to avoid risk. That's impossible. It's to manage it. The big lesson from the Dutch East India Company was to diversify. Don't bet on just one ship. And today's version of that is the Exchange Traded Fund, or ETF. It's a single stock you can buy that holds a tiny piece of every company in the market, which lets you invest in all the ships at once.
So let's leave it with this. The next time you see those panicked headlines and the market is going completely haywire, you can just ignore all the noise. You only need to ask yourself one simple question.
Which side is pulling harder? Is this about profits, or is this about discount rates? Because if you can answer that, you'll understand what really truly matters.
Welcome to The Explainer. Today we're getting into the psychology that drives the markets and, our own investment choices. And it turns out the biggest risks might not be out there. They're actually right here, between our ears.
So, to really get this, let's start with a story. Meet Steven. He's a university professor, and he's having this much-needed hotel staycation with his family. Picture it. He's by the pool, totally relaxed, everything's great.
So, a few weeks back, Steven had put a little money into the stock market. Kind of on a whim, And now he's just chilling. And another whim hits him. He thinks, hey, why not? And grabs his laptop to see how his stocks are doing. And bam, just like that, his perfect vacation is over. He's just staring at the screen, and this wave of absolute panic washes over him. All he sees is red. And his brain immediately starts calculating how many future family trips have just vanished. Yeah, his weekend is definitely ruined.
Steven's whole gut-wrenching moment is basically the perfect example of what the legendary investor Benjamin Graham was talking about ages ago. He knew that the real fight isn't against the market, it's against ourselves. Okay, so what in the world just happened to Steven's brain there by the pool? To get that, we kind of have to pop the hood and look at the two competing systems we've all got running the show upstairs.
And what's wild is that this is a survival thing, hardwired into us for thousands and thousands of years. Our brains are built to spot danger way before they spot opportunity. So when you see a portfolio full of red numbers, your brain doesn't see a temporary dip, it sees a tiger. So the psychologists Daniel Kahneman and Amos Tversky, they figured this out. They called them System 1 and System 2. Think of System 1 as your fast, emotional reptile brain. It's your gut feeling. Then there's System 2, your thinker brain. It's slow, it's logical, and it takes real work to use it. And because it's hard work, our brain almost always prefers the easy route, which means System 1 is usually in the driver's seat.
And right there is the crucial moment for Steven. When he saw those losses, his emotional System 1 was just screaming, "Sell, sell, get out now." But then, somehow, his logical System 2 managed to grab the microphone and say, "Hold on, remember the plan, we're a long-term investor." It was a really, really close call.
So, if System 1 is the part of our brain that hijacks our decisions, it has some pretty powerful tools it uses to mess up our best plans. Let's meet the big ones: fear, greed, and of course, FOMO, the fear of missing out. And we're going to start with the biggest, baddest one of them all: fear. I mean, just look at this. This finding from behavioral economists is absolutely mind-blowing. The pain you feel from losing, say, $100, is about 3 times stronger than the joy you'd get from gaining that same $100. It's no wonder we're so terrified of seeing red in our accounts.
And you know what makes that fear even worse? A little trap called myopic loss aversion. It basically means the more you check your portfolio, the more you see those little ups and downs, but you really feel the downs. And all that checking just makes you more and more scared and more likely to do something stupid.
And oh boy, does the financial media know this. They use these big, scary, emotional words: crash, slump, doom. Why? Because it works. It triggers our System 1 brain. It grabs our attention, and it gets them clicks. They are literally feeding our inner reptile exactly what it's looking for: a threat to freak out about.
Which, of course, brings us to the most important question of all. When you feel that same panic Steven felt, when your System 1 is screaming at you to just sell everything and run, what's the right thing to do?
Well, the Nobel Prize-winning economist Richard Thaler has some advice that is just beautiful in its simplicity. He says, change channels, turn the show off. In other words, stop feeding the fear. The best thing to do is often nothing at all. Just walk away from the screen.
All right, now let's go to the complete other end of the spectrum from fear. Here we find an enemy that's just as dangerous: overconfidence. You know that little voice in your head that whispers, "Hey, you're smarter than these other people. You've got this all figured out." Yeah, that's the one.
There's actually a name for this. It's called the Lake Wobegon effect. And this classic study just says it all. A whopping 93% of American drivers, which is mathematically impossible, by the way, rated themselves as being above average. And in investing, that translates into us thinking we can pick the one winning stock or time the market perfectly, when all the evidence says that's pretty much impossible.
And that is exactly why Bill Gates says that success is a lousy teacher. You know, you make a few good trades and suddenly you feel like a genius. You feel invincible. And that makes you take bigger and bigger risks until, well, your luck runs out. It's why they call overconfidence the mother of all behavioral biases.
Okay, let's zoom out for a second. What happens when you take the fear and overconfidence from millions of individual people and you throw it all together into the market? Well, you get these predictable psychological roller coasters of boom and bust. You get hype cycles.
And these cycles pretty much always follow 5 classic phases. You've seen this movie before, with everything from the dot-com bubble to crypto. First, you get displacement. A real, genuine new opportunity pops up, and some smart people get in early. Then comes expansion. The story starts to spread. The media is talking about it, your friends are talking about it, more and more people pile in. Which leads to euphoria. This is the peak. Greed just completely takes over. People think they're all going to get rich. But then, the crisis hits. They call this a Minsky moment. It's the instant the bubble pops. Panic buying suddenly flips to panic selling. And finally, you get revulsion. This is total pessimism. Everyone swears they'll never invest again, and prices fall way below what they're actually worth. And ironically, that's what sets the stage for the whole cycle to start all over again.
Okay, so we know our brains are kind of buggy, and we know markets go through these crazy emotional cycles. So the big question is, how do we actually protect ourselves from, well, ourselves, and make better decisions? The whole game is about forcing yourself to use that slow, logical System 2 brain. So here are a few ways to do that. First, just know your biases. Just being aware that your emotional System 1 is trying to take over is a huge first step. Second, go on an information diet. This is Thaler's advice, right? Stop obsessively checking the news and prices every hour. Third, try to be a little bit of a contrarian. Train yourself to get a little nervous when everyone else is giddy and euphoric. Fourth, to keep your ego in check, just remember Sir Isaac Newton, one of the smartest people who ever lived, lost a fortune in a market bubble. If it can happen to him, it can happen to us. And finally, try to be a rational optimist. Despite all the scary headlines you'll ever read, in the long run, pessimism has been a terrible guide.
And at the end of the day, that's really the key takeaway here. Trying to perfectly time the market's ups and downs is a recipe for disaster. The real goal is to understand the psychology that's driving the whole thing, and most importantly, learn how to manage your own reactions to it.
Which leaves us with one final thought to chew on. Benjamin Graham told us that our own worst enemy is likely to be ourselves. So the real challenge, for all of us, is to figure out how do we turn that enemy into our absolute best ally.
Hey, welcome back. Today, we're jumping into one of the most dynamic, complex, and, let's be honest, one of the wildest financial stories out there.
China's stock markets.
So let's kick things off with this quote. It sounds more like a pitch for an action movie than a piece of market analysis, right? A robbery, a plane crash, and a comforting bowl of noodles.
But no, this isn't a Hollywood script. It's actually the perfect way to think about the chaotic, super unpredictable, and in the end, totally transformative journey of China's stock markets. It's how they went from their crazy beginnings to where they are today, right on the world stage.
To really get what these markets are about, you have to go back to the start. Picture this. It's the early 1990s in China, a time of massive, almost chaotic change.
Okay, just imagine this for a second. On your very first day in the country, you land in Shenzhen, and it's basically just one giant construction site. Within a few hours, you're changing money on the black market, then you get robbed, and to top it all off, your plane crash lands in a rice paddy. Now, that's not just a bad travel story. It's the perfect metaphor for the high-risk, high-reward, totally unpredictable nature of China's early markets. All right, so to understand how this market actually works, you've really got to get your head around its fundamental and, yeah, often confusing two-sided structure. It's not like anywhere else. So here's the most important thing to get. There are two completely separate financial worlds here. First, you've got the onshore market, inside mainland China. The currency is the renminbi, or CNY, and the whole thing is powered by a massive army of 170 million local individual investors. Then you have the offshore market, which is based in Hong Kong. It uses a totally different, internationally traded version of the currency, the CNH, and it's all driven by big global investment firms.
And because of that setup, you get two different kinds of stock. Companies listed onshore are called A shares. They're priced in the local currency and, for a long time, were just for local investors. But those exact same mainland companies can also list offshore in Hong Kong. We call those H shares. They're priced in Hong Kong dollars and they're open to anybody in the world.
So what happens when the same company has both? Well, you get this truly bizarre thing called the share premium. It exists because China's super strict rules on money have historically kept these two markets almost totally separate. Think of it like this. It's the same exact product, but it costs 30% more in one store than it does in the store right next door. Same company, same ownership, but a totally different price, all depending on where you buy the stock.
And this chart right here shows you that gap perfectly. Take a look at the famous Tsingtao Brewery. For years and years, that top line, its A shares, traded way, way higher than the bottom line, its H shares. That huge gap only really started to shrink around 2014. That's when a program called Stock Connect was launched, and it basically built a bridge between the two, finally letting international and mainland investors trade in each other's markets and bringing those prices closer together.
So how did the market evolve from that wild, wild West beginning? Well, you can kind of break its history down into four big waves of growth, and each one was driven by a completely different part of China's economic story. It all kicked off in 2001, when China joined the World Trade Organization, sparking this incredible export boom. Then, in 2006, the country's huge state-owned banks all went public. By 2007, the focus shifted to the Chinese consumer, who was finally waking up and starting to spend big. And by 2013, the unbelievable power of individual retail investors, what they call the Dama army, became a force you just could not ignore.
And man, was it a roller coaster. That first wave, the export boom, sent the Shanghai market up more than 50% in the year 2000 alone. But of course, the party came to a sudden stop. The market then crashed 55% over the next 4 years. It was a classic boom and bust cycle.
Then came the second wave. In 2006, these mega banks, like the Industrial and Commercial Bank of China, went public, and they raised an absolutely mind-boggling $27 billion in just a few days. The scale was just on another level. But listen, you can't possibly talk about China's markets without understanding the Dama army. Now, this isn't an actual army, it's a force of middle-aged female retail investors. They are legendary for their sharp instincts and their collective power. They can move entire markets, and get this, they drive about 80% of the A-share market's daily trading volume. 80%!
And this is a perfect illustration of their power, especially when you combine it with the rise of the consumer. Just look at the sportswear brand Anta. Its stock has gone up more than 18 times since it listed back in 2007, and that was fueled directly by the spending power of China's middle class. This is exactly what consumer-driven growth looks like on a chart.
Okay, so this brings us to the modern era, a story that's really defined by this epic clash between massive private tech companies and the ultimate authority of the Chinese government.
That in 2014, the e-commerce giant Alibaba launched the biggest IPO the world had ever seen, raising $25 billion US. This was the moment that China's new tech titans really announced their arrival on the global stage. I mean, these were companies that were bigger and more innovative than a lot of their rivals in the West.
But, and this is a huge but, maybe the most important but in this entire story, in China, no company, I don't care how big or how innovative it is bigger than the government. The state always has the final say.
And if you want to see what that power looks like, here it is. In 2021, Beijing just decided to crack down on the entire private education sector. They saw it as causing social inequality and being a huge financial burden on families. So overnight, the stock of TAL Education Group, one of the leaders in the market, it didn't just fall, it fell off a cliff. It is just a stark, brutal reminder of who is really in charge of the economy.
So after all these waves of growth, these booms and busts, and these government crackdowns, where does that leave us today? Let's take a look at how this market has finally come of age.
From those chaotic early days, China's stock markets have grown into the second largest in the world by trading volume. And as you can see from this visual, they absolutely dwarf pretty much every other market on the planet except for the United States.
So that transformation is really the key takeaway here. The market has gone on this incredible journey from a dusty, unpredictable building site to a global financial anchor. This isn't just a domestic story anymore. What happens in Shanghai and Hong Kong today really sets the pulse for markets all across Asia and even the world.
So here's the final question. China's markets are now global giants, there's no doubt about it. But they are still being driven by consumers from the bottom up and directed by the state from the top down. So what will their next transformation look like? That fundamental tension between the market and the state, that remains the central, defining question for its future.
Today, we're diving into a tale of two cities, Hong Kong and Singapore. Now, these are two of Asia's most developed stock markets. You could call them rivals, you could call them partners. They both share this common colonial history, but they've grown into having completely different personalities, and you can really see that in how their markets work. Let's get into it.
You know, to really understand Hong Kong's stock market, you first have to get a feel for the city itself. The late writer Jan Morris just nailed it with this quote. This place isn't calm or quiet, it's a cauldron of raw, chaotic human energy. And that exact same seething, hissing, electrifying personality, it's baked right into the DNA of its financial markets.
So, how on earth did this chaotic city end up creating one of the world's most famous stock indices? Well, for that, we've got to go back to the summer of 1969, a time when Hong Kong was just dealing with constant, non-stop turmoil.
The 1960s in Hong Kong, wow, they were just defined by instability. We're talking massive refugee crises, politically charged riots breaking out over things like ferry fares, and a whole series of bank runs that completely shook public confidence. At one point, they literally had to fly in plane loads of British pounds just to keep the banking system from collapsing. And it was in this incredibly tense atmosphere that someone had the idea to create a stock index.
So, right in the middle of all this chaos, one guy, a banker named S.H. Ho, saw an opportunity to create some order. As the chairman of Hang Seng Bank, he thought, you know what Hong Kong needs? It needs its own Dow Jones, a single, reliable number that could show the health and direction of the entire market. And, of course, it wouldn't hurt that it would be some pretty great publicity for his bank, too. Now, remember, this is way before computers, so creating this index was just a huge manual job. A small team of analysts, led by a guy named Stanley Kwan, would literally walk over to the stock exchange floor, copy down all the day's closing prices off a giant blackboard, walk all the way back to their office, and then do all the math with pencils and a typewriter. I mean, can you even imagine? It's an incredible image. And after all that hard work, on November 24th, 1969, the Hang Seng Index was finally born, and its starting value, a pretty humble 158 points.
And from that simple beginning, just 158 points, the index went on this incredible, wild, and ultimately explosive journey. At its peak, it soared past 30,000. It really, truly became the pulse of the city's economy.
But the story definitely doesn't stop there. Hong Kong's market has been in this constant state of reinvention, always changing, always driven by things like political handovers, financial crises, and just a massive shift in the types of companies that define it.
A huge moment came in the early 80s. There was widespread panic over the upcoming handover to China, and it caused a full-blown currency crisis.
The solution? The Hong Kong dollar peg. Basically, they just fixed their local currency to the US dollar. This move instantly restored confidence because it was a guarantee that all the city's money was backed by stable US dollar reserves.
But, and this is a huge but, this solution came with a major trade-off. Think of an economy as having two shock absorbers, its currency exchange rate and its interest rates. Well, by locking its exchange rate, Hong Kong basically welded one of those shock absorbers in place. So what does that mean? It means the other shock absorber, interest rates, has to take all of the bumps. And that's the key takeaway here. They got stability, but they gave up control, turning their stock market into a roller coaster that's directly tied to whatever the US decides to do with its monetary policy.
At the same time, the actual players in the market were changing in a huge way. You had the old British colonial trading houses, the Hongs, and they started to give way to these powerful local tycoons like Superman Li Ka-shing. Then came the Macau casino giants who all listed in Hong Kong to raise money. And most recently, we've seen this big homecoming of massive mainland Chinese tech firms like Alibaba who are moving their listings away from the US and over to Hong Kong.
And this flood of tech companies is fundamentally changing the market. The days when it was all about banks and property developers are fading fast. Hong Kong is now squarely on the path to becoming a tech-heavy powerhouse, what some people are calling the NASDAQ of the East.
All right, now let's hop on a plane and fly 4 hours south to our second city. Because if Hong Kong's market was forged in chaos, Singapore's was the complete opposite. It was a product of careful, deliberate design. From the moment it became independent, Singapore's leaders had a really clear strategy: build a world-class financial hub by creating rock-solid rule of law, low taxes, and absolutely zero tolerance for corruption. The goal was to become a safe harbor for international money. But don't mistake deliberate design for boring. Oh no, Singapore had its own moment of just pure, unadulterated chaos back in 1995. A single 28-year-old trader, Nick Leeson, working out of a Singapore office, secretly racked up these enormous, unauthorized bets on Japanese stocks. In a terrifyingly short amount of time, his losses spiraled to $1.3 billion. That was so much money, it single-handedly bankrupted Barings Bank, a 233-year-old British institution. So yeah, that staggering collapse was a huge wake-up call, and it made Singapore double down on its reputation for strict regulation. But instead of chasing the big tech wave like Hong Kong, Singapore made a very deliberate choice to focus its market on cultivating two very distinct and very different niches.
And these two niches are polar opposites. I mean, on one hand, you've got these massive, really volatile agricultural commodity traders. Their fortunes just rise and fall with global food prices. But on the other hand, you have Singaporean REITs, or S-REITs, and these things are models of stability. They own physical properties like malls and office towers, and, get this, they're required by law to pay out 90% of their rental income as dividends to investors.
Just look at this. On the left, that's the wild, jagged ride of an agribusiness stock. And on the right, the much smoother, steadier journey of a real estate investment trust. It's this exact combination of high risk and low risk that gives the Singaporean market its really unique character. So, we've seen their unique journeys, right? One was born from chaos and is constantly reinventing itself. The other was a product of deliberate design and focuses on cultivating specific niches. Now, let's put these two financial giants head-to-head and see how they stack up. Okay, so looking at them side by side, it's not just a difference in features, it's a real strategic divergence. Now, both markets are what we call highly concentrated, meaning a few big companies dominate. But their core personalities are just miles apart. Hong Kong is often described as impulsive and capricious. Its fate is deeply tied to mainland China and that booming tech sector. Singapore, on the other hand, is engineered for stability. It's anchored by those dividend-paying REITs and tends to be more sensitive to global, especially US market trends.
And all of this leaves us with a final, really fascinating question. As their paths keep diverging, with Hong Kong betting big on Chinese tech and Singapore betting on diversified global niches, which city's model is going to end up shaping the future of finance in Asia? Is it the dynamic, chaotic cauldron or the deliberately designed, stable hub? Well, only time will tell.
All right, today we are diving deep into the wild, chaotic, and absolutely fascinating world of the Indian stock market. And we're going to do it by following the journey of one man who pretty much cracked the code, a guy they called the Big Bull of Dalal Street. But here's the thing, this isn't just the story of one legendary investor. His journey is like a key that unlocks the secrets of the entire Indian market. And it all started not in some fancy boardroom, but right in his family's living room. So picture this. It's the 1970s. A teenage Rakesh Jhunjhunwala is just sitting there, completely captivated, listening to his dad and his buddies passionately argue about stocks over tea. They weren't just guessing. They were dueling with facts and logic, debating profits and valuations. For young Rakesh, it was pure magic. He was hooked. Instantly. What's so cool is that Rakesh was tapping into a tradition that was already a century old. Long before he came along, the very first stockbrokers in India gathered right here, under banyan trees, in a place that would one day become Dalal Street, India's Wall Street. He was stepping into a story that had started long, long before him. So when Rakesh wanted to jump into the market himself, his father, who was an income tax officer by the way, he didn't give him any money. Nope. Instead, he gave him 2 conditions. Just 2. Read the news every day. And never, ever borrow money from friends. That's it. So simple, but so powerful. And guess what? It totally worked. His first major investment in a company called Tata Tea tripled in value. This huge early win basically set the strategy for his entire career. Find good, solid companies and buy their stock when it's on sale. You see, he wasn't gambling. He was investing with a very clear, very simple philosophy. Now here's where luck, or maybe genius, comes in. Rakesh's timing was just perfect. For decades, India's economy had been stuck in the slow lane, weighed down by all this central planning. But then, in 1991, everything changed. The government just threw the doors wide open, deregulated entire industries, and basically put out a giant welcome sign for investors. The tortoise suddenly became a hare. And the market went absolutely nuts. I mean, to give you an idea of the explosion, the main stock index, the Sensex, had just managed to cross 1,000 points. Then, in just a couple of months, it doubled to 2,000. And then it doubled again to 4,000. It was a boom like nobody had ever seen before. Dalal Street basically became a madhouse. Just imagine this scene, hallways crammed with people, shouting tips, pushing each other around, trying to give advice to literally anyone who looked like they had cash. Everybody wanted in. I mean, what could possibly go wrong? Well, as it turns out, pretty much everything. A gigantic scandal erupted, all centered around this charismatic broker named Harshad Mehta. Turns out he was running a massive scheme to manipulate stocks, working with crooked bankers and politicians. The dream turned into an absolute nightmare, practically overnight. And the fallout? It was devastating. At its absolute worst, the market crashed by a staggering 72%. The party was over. A long, painful bear market was just getting started. And this is the moment that makes the legend. While everybody else was panicking, selling everything they owned and running for the hills, Rakesh did the exact opposite. He stuck to his simple philosophy, saw a massive buying opportunity in the crash, and he kept investing. That one decision, that courage, is what built his entire empire. Rakesh's story is the perfect illustration of this famous quote about India. Because to really get the Indian market, you have to embrace its contradictions. As the country recovered from that crash, this duality became the defining feature of its economy. It's a place of incredible contrasts, and that's exactly where the opportunities are hidden. So think of it like this. There are 2 Indias operating inside one country. On one side, you've got these global powerhouses, world-class tech and pharmaceutical companies, and on the other, you have what we'll call the vast hinterland, this enormous, complex domestic market stretching across thousands of towns and villages. So let's look at that first India. Because the country has this huge pool of English-speaking, highly educated talent, its pharma and IT companies just exploded onto the world stage. You can see the trend right here on these charts. It's just a spectacular 2-decade-long climb for their stocks. But the other India, the vast hinterland, it plays by a completely different rulebook. It's this incredible patchwork of different cultures, different languages. Here, big families are focused on the basics, the necessities. And for a business to win here, it's not about global strategy. It's about deep local knowledge. You sell a lot of motorcycles here, not so many fancy cars. Then, about a decade ago, a huge disruption started to stitch these 2 Indias together. It all began with this massive push for financial inclusion. First, they rolled out a biometric ID for over 1 billion people. That allowed banks to open 255 million new accounts in just 2 years. All of a sudden, with QR codes and simple apps, hundreds of millions of people had a bank in their pocket for the very first time. And this digital revolution, like all revolutions, created clear winners and losers. The younger, more nimble private banks saw the opportunity and just soared. But the big, old, state-owned banks, they got left in the dust, completely stuck in the slow lane. The market rewarded the innovators, big time. Then came the second shockwave. In 2016, the billionaire Mukesh Ambani launched a new telecom company called Jio. He built a brand new 4G network from scratch and then offered data and calls at prices so ridiculously low, it was basically a declaration of war on the entire industry. And the effect was just brutal. His competitors had to slash their prices by 2/3 just to stay alive. Many of them went bankrupt. You can see it clear as day in these diverging stock prices. The entire market was reshaped, and when the dust settled, only 3 major players were left standing. Okay, so after all that chaos, what does this all mean for an investor today? Well, here's the playbook. The market is incredibly diverse. It's a real masala mix of global exporters and local champions. It's not dominated by just a few huge companies. And here's the real kicker. Corporate profits, when you look at them all together, are surprisingly stable. And yet, the market itself is wildly volatile. This right here is the great paradox of the Indian market. So let's just pause on that for a second. How on earth can company earnings be so steady while stock prices and the currency are on a constant roller coaster? A lot of it comes down to things like the flow of foreign money and a sensitivity to global oil prices, which cause these huge emotional swings in the market. And that brings us full circle, right back to our big bull, Rakesh Jhunjhunwala. His simple, patient philosophy is the perfect answer to this paradox. He just understood that all that short-term volatility, it was just noise. The real money was made by focusing on the gap between a stock's panicked price and the stable, long-term value of a great Indian company. In the end, the Indian market is this incredible study in contrasts. It's ancient but modern, it's global but fiercely local, and it's stable but unbelievably volatile. And the lesson from its entire history, and from heroes like Rakesh, is that for anyone willing to learn its unique rhythm, the question isn't if there's an opportunity. The real question is, where will you find it next? When you think about the giants of tech, 2 names always come up, Taiwan and Korea. But here's the thing, they didn't get to the top by following the same playbook, not even close. So today, we're going to unpack how these 2 powerhouses built their modern economies on 2 completely different blueprints. Believe it or not, this is how travel guides used to describe Taipei. Yeah, a city built for getting things done, not for looking pretty, all concrete boxes and workshops. So how on earth did this ugly duckling turn into one of the most important tech hubs on the planet? And that question is really at the heart of what we're talking about today. We're going to trace the parallel but totally distinct journeys of Taiwan and Korea, 2 nations really forged by history and crisis, to understand how they ended up with 2 very different yet equally powerful economic engines. Okay, so to really get this, let's use a little metaphor. Think of Taiwan as a nation of master mechanics. The people obsessed with perfecting the intricate, complex guts of our technology. Now picture Korea as a nation of expert baristas, crafting the perfect global macchiato. It's sleek, it's stylish, and everybody wants one. So that brings us to the big question, right? Why did Taiwan become the world's high-tech workshop, making the essential parts inside your favorite gadgets, while Korea went all in on building these massive, globally recognized brands? Well, the answer lies in 2 brilliant but fundamentally different strategies. Let's start with Taiwan. You see, its story is all about quiet dominance. It's about prioritizing engineering excellence way above building flashy global brands. It's a strategy of being absolutely essential but often completely invisible. You might think Taiwan's story is all about semiconductors, and we'll get there. But, to really get their philosophy, we need to start with something a bit more down to earth, a bicycle. The journey of a company called Giant Bicycles perfectly nails down Taiwan's whole economic model. I mean, just look at this progression. Giant started out as a contract manufacturer, the mechanic, for bigger, more famous brands. But they didn't just assemble bikes. They totally mastered the craft. They then used that deep engineering expertise to innovate, eventually launching their own brand and pioneering game-changing tech like carbon frames. They became the best by actually doing the hard work, not just by slapping a fancy logo on something. And, well, here's the payoff for that strategy. By just focusing on being the best at manufacturing, Giant achieved incredible financial success. It's just proof that you don't always need the flashiest product to absolutely crush it. Pure engineering skill can be wildly profitable. Now, as impressive as Giant is, the ultimate example of Taiwan's workshop model is a company that's almost certainly inside the device you're using to watch this right now. Let's talk about TSMC. Okay, so what's the secret sauce here? It's this foundry model. TSMC doesn't design its own chips. It doesn't sell a TSMC phone. Instead, it dedicates all of its energy to one single thing, being the world's best manufacturer of chips for everybody else. Apple designs the chip, TSMC builds it. What that does is it makes them totally indispensable to the entire global tech ecosystem. The company's visionary founder, Morris Chang, absolutely perfected this model. And the result? Just staggering growth. It's a testament to the immense value you can create by just being the world's most reliable and advanced mechanic. They don't need to be a household name because their tech is already in almost every household. So, if you boil it all down, Taiwan's whole approach is this: be the absolute best at making the critical, complex parts. They are the engine, the transmission, the brains of the whole operation, and they're happy to leave the shiny exterior and the brand name to their clients. It really is mechanics over macchiatos. All right, let's shift gears and head over to Korea, which took a completely different path. After the total devastation of the Korean War, the goal wasn't just to rebuild, it was to build global empires. And their strategy? It was the polar opposite of what Taiwan was doing. And the engine driving this whole mission? It was something called the chaebol. The word literally combines rich and clan. These are massive, family-controlled conglomerates that were absolutely instrumental in pulling South Korea out of poverty. You know the names: Samsung, Hyundai, LG. These companies were basically designed to be global giants right from day one. I mean, the scale of this transformation is just mind-blowing. Samsung didn't start in tech. It started as a tiny company trading noodles and dried fish. To go from that to a global tech powerhouse, that takes an incredible, just relentless ambition to not just compete, but to absolutely dominate on the world stage. And this quote from Samsung's chairman, Lee Kun-hee, man, it just perfectly captures the sheer intensity of Korea's mission. He wasn't okay with just making cheap, forgettable electronics. He demanded a revolution in quality, and he famously ordered a mass burning of products he thought were defective. This was about forging a world-class brand, no matter what it took. And guess what? It worked. Samsung became a global icon, a symbol of the miracle on the River Han, South Korea's unbelievable economic comeback. The company's whole story is about building an empire, not just, a workshop. But of course, the road wasn't always smooth. Both nations faced devastating crises that really tested their models, and for Korea, it actually forced this really surprising evolution. Okay, so 1997, the Asian financial crisis hits, and for Korea's debt-heavy chaebol model, it was like a wrecking ball. The currency crashed, entire empires collapsed, and millions of people lost their jobs. But out of all that devastation, something totally new and unexpected started to grow. A whole new generation of entrepreneurs, backed by local money, began building internet companies, creating a powerful second engine for the Korean economy. And this, right here, is where the story takes this absolutely fascinating turn. Because beyond tech, Korea started exporting something else entirely: its own unique brand of cool. This is what we call Hallyu, or the Korean wave. It started with TV dramas that got all of Asia hooked, then it just exploded globally with K-pop acts like BTS. It even conquered Hollywood, with films like Parasite winning the Oscar for Best Picture. And listen, this was no accident. It was a strategic pivot. Korea had learned how to build empires not just in electronics, but in entertainment, fashion, and culture itself, creating another massive wave of global influence. All right, so we've seen these two very different journeys. Let's put the two models side by side and see how they really stack up. So this scorecard kind of lays it all out, nice and clean. Taiwan's focus on components makes it a stable, super reliable workshop for the world. In contrast, Korea's obsession with global brands has built empires, sure, but it also leads to more wild yo-yo swings in the market. And of course, each model has its own Achilles heel. For Taiwan, it's that heavy reliance on a few huge clients, which creates some pretty big geopolitical risks. And for Korea, there's this thing called the Korean discount. Basically, the complicated family-run structures can sometimes make global investors a little nervous. And so that leaves us with the big question, doesn't it? As we look to the future of tech, which strategy is going to win out? The quiet, indispensable engineer building the very foundations of our world, or the bold empire builder capturing the hearts and minds of consumers everywhere? Honestly, the answer is still being written. All right, today we are diving deep into the fascinating and, often misunderstood world of Southeast Asia's stock markets. And we're going to do it through a lens you probably weren't expecting, a really unique style of Indonesian pop music.
It's a great question, right? And it might sound a little strange, but stick with me, because the answer reveals something fundamental about this dynamic region. A truth that explains its wild swings, its incredible resilience, and the massive opportunities hiding inside.
So, to really understand these markets, you first have to get a feel for the culture. And believe me, there is no better place to start than with a music genre that is as popular as it is controversial.
So, what even is dangdut? Well, imagine you took techno, some Bollywood hits, a little Middle Eastern pop, and mashed it all together with a rhythm that feels completely off, but somehow it just works. It's the performances, though, that really cause a stir. You have female performers with these incredibly flexible waists, and their hip movements are so provocative they've actually been debated in Parliament. I mean, they've even been investigated by the National Security Council. And that right there perfectly illustrates our central theme. Dangdut is hugely popular, but it's also rejected by parts of society. And that mirrors the contradictions you see across the entire region. It's this constant struggle between old and new, religious and secular, the city and the village. And that tension, that's the key to everything. Now, let's see how this plays out in the real world, because the story takes a really dramatic turn. We need to go back to 1997, a year that started with a massive boom and ended in an absolute catastrophic bust. Hemingway's famous line just captures the Asian financial crisis perfectly. For years, things were just gradually building up. Companies were borrowing, investors were cheering, the growth story seemed completely unstoppable. Then, in the blink of an eye, it all came crashing down. Okay, so here's how the stage was set. In the booming 90s, companies all across Thailand and Indonesia were on an absolute borrowing spree. And crucially, a lot of that debt was in US dollars. At the time, it seemed like a totally smart move to fuel all this incredible growth. And this is where the story gets really specific, because one single deal can tell us the whole story. On one side, you've got Peregrine, this swashbuckling Hong Kong investment bank. And on the other side, an Indonesian taxi company called SteadySafe, which had these huge ambitions to become a construction conglomerate. So Peregrine loaned SteadySafe a staggering $260 million. And get this, it was an unsecured loan. The bankers just figured the taxi company's earnings were rock solid and that, nothing could possibly go wrong. It was a huge, huge gamble placed on everything staying stable. Then came the suddenly part. On July 2nd, 1997, Thailand devalued its currency, the baht. And a chain reaction just ripped across the entire region. The Indonesian rupiah went into an absolute freefall. For companies like SteadySafe, that giant US dollar loan became an impossible mountain of debt, literally overnight. And the result? It was absolutely catastrophic. As this chart shows, SteadySafe's stock price didn't just fall, it completely evaporated. The company was wiped out. And it took its lender, Peregrine, which was the largest investment bank in Asia outside of Japan, down with it. Just a total collapse. Warren Buffett's famous words could have been written for this exact moment. When that tide of easy money went out, the crisis exposed just how many companies across the region were totally financially vulnerable. It turns out that whole boom had been hiding some immense risks. But here's the thing, this is not just a story of collapse. In fact, the most incredible part is what happened next. The crisis revealed this deep well of resilience and creativity that would fuel one of the most epic comebacks you've ever seen. So meet the Sandwich Man, Siravet Vorovetfutikan. He was a legendary stock trader, a multimillionaire known as the Phantom. The crash wiped him out, completely. Did he give up? No way.
He started selling sandwiches that his wife made, right out of a phone box on the streets of Bangkok. He slowly rebuilt his life and became this national symbol of pure tenacity.
And that spirit of adaptation wasn't just in one person. Entire industries had to reinvent themselves. Thai hospitals, their local market, just gone, pivoted to medical tourism, offering world-class care to foreigners. The Philippines, they leveraged their huge English-speaking population to build a massive call center industry, basically from the ground up. This resilience set the stage for the next 2 decades of growth. A massive investment in infrastructure connected the region like never before, and that unleashed the power of hundreds of millions of new consumers. So, as all these new roads and bridges connected thousands of towns and villages, a really predictable and powerful pattern started to emerge. A family would upgrade from a motorcycle to their very first car. Then they'd buy their first home. And pretty soon, they were spending their weekends and their new income at the local shopping mall. Then came the digital leapfrog. And what you're seeing here is so important. About half the population in large parts of the region didn't even have a basic bank account. But you know what they did have? Mobile phones. This one piece of technology unlocked millions of people, bringing them into the modern economy through digital payments and e-commerce for the very first time. Okay, so all of this brings us back to our central idea. We've seen the clash of culture, the sudden crash, the amazing rebound, and the rise of the consumer. All these different threads weave together to create this really unique market paradox. Okay, so this is it. This is the heart of the paradox. On one hand, the actual companies in these markets are remarkably stable. Their earnings come from selling everyday essentials, noodles, cigarettes, mobile phone plans. But on the other hand, the currencies and the stock market prices are incredibly volatile. Why? Because they're heavily influenced by foreign investors who can pull their money out in a heartbeat. So what this really means is that these markets think local. The businesses that dominate are focused on the domestic consumer, not on global exports. And this provides a steady, predictable foundation of earnings year after year that's often completely disconnected from all the global drama. And you know what? This paradox is even embodied in its leaders. Take Indonesia's president, Jokowi. This is a guy who was a furniture seller who rose to the presidency. He champions foreign investment, but at the same time urges his people to hate foreign products. His biography is literally titled Man of Contradictions. He is the perfect symbol for the entire region. And here's the data that really drives home that think local idea. In Indonesia, the top 5 companies make up over 60% of the entire market. I mean, that is almost double the concentration you see in China or India. It just shows you how a handful of these large, stable, local giants truly anchor the economy. So we end right where we began, with a paradox. These markets are this dizzying mix of stability and volatility, of local tradition and global forces. And it leaves us with a really fascinating question. In a world that's dominated by these massive, more predictable markets like the US and China, could the most exciting opportunities actually be hidden right here in the heart of the contradiction? So, when you think about Japan's economy, what's the first thing that pops into your head? For a lot of people, it's this story of a massive boom, an even bigger bust, and then just decades of going nowhere. But what if I told you that narrative of decline is really only half the story? Today, we're going to dig into this surprising and honestly pretty innovative reality that's been bubbling up just beneath the surface. Okay, to really get what's going on in Japan, I want you to picture 2 different swimmers. First, you've got someone like Miko Nagaoka. This woman started swimming in her 80s, and by the time she was 105, she held 18 world records for her age group. She's a symbol of this quiet, incredible endurance, a vitality that most people just completely overlook. And then you've got the other swimmer, the naked swimmer from the 1980s who represents just pure, reckless, speculative excess. This contrast, it's everything to our story today. All right, let's start with the story that everyone thinks they know. The cautionary tale, right? The bubble and the bust. For decades, this has been the defining narrative of Japan's modern economy. I mean, the sheer absurdity of the bubble years, you can't make this stuff up. We're talking about a time when housewives in Osaka were sipping coffee that was literally sprinkled with gold dust. And you had Japanese companies just snapping up trophy assets like Rockefeller Center in New York. This quote here says it all. The idea that one little patch of land in Tokyo could be worth more than all of France. That's how crazy things got. And this number? 38,915. This was the absolute peak of that madness. At the very end of 1989, Tokyo's main stock index, the Nikkei 225, hit this number. That's a six-fold increase from where it was at the start of the decade. The market was an absolute bonfire. But you know what they say? What goes up must come down. And boy, did it come down. Over the next 20 years, the Nikkei didn't just have a correction, it completely collapsed, wiping out a staggering 80% of its value. This is what kicked off the infamous lost decade, a period of economic stagnation that really just haunted Japan for years and years. And this brings us right back to our second swimmer. You see, when that tide of easy money finally went out, it turned out almost everyone had been skinny dipping. The crash exposed all this speculative rot that was hidden inside the system, with companies making these wild, crazy bets in the stock market that just went completely sour. This was the Great Unwinding. So, okay, that's the cautionary tale. But here's where the story takes its first really surprising turn. Because that other narrative you hear all the time, that Japan's aging population is this huge crisis, it's not just wrong. It might actually be the complete opposite of the truth. Now look, the core fact is undeniable. Japan is what they call a super-aged society. Over 28% of its people are 65 or older. For years, the headlines have been screaming that this demographic time bomb was going to doom their economy. But what if that burden was actually a massive opportunity in disguise? Well, this is how Japan is totally flipping the script. To care for its elderly population, the country has become a world leader in robotics and elder care tech. We're seeing everything from Panasonic's robot suits that literally help people walk again, to these adorable therapeutic robot seals that comfort residents in nursing homes. The demographic problem has actually become a huge driver of incredible innovation. And the economic potential here is just massive. By 2050, it's estimated that Asia's aging population is going to need $157 trillion set aside for retirement. Think about that. All of that cash has to be invested somewhere, creating this incredibly powerful engine for the financial markets. Okay, so to really understand both the stagnation of the past and the potential for a new boom, we have to peek under the hood of corporate Japan. It's a system with a powerful old guard and some brand new rules. And it's important to remember, Japan isn't new to any of this. It has a long, really sophisticated financial history. I mean, they created the world's first organized futures market for rice way back in 1730. But it's the modern corporate structure that really set it on its unique path. At the very heart of the system is something called the keiryatsu. The easiest way to think about it is like a big corporate family. You have a group of companies, think Nissan, Canon, all connected to one central bank, and they all own shares in each other. Now, this creates incredible stability, and it protects managers from, pesky shareholders who are always complaining, but it doesn't always prioritize making a profit. And right there, that's the core problem, at least from an investor's point of view. Because managers were so protected by this web of cross-shareholdings, a lot of Japanese giants became pretty inefficient and way less profitable than their competitors over in the US or Europe. So the modern attempt to shake up this old system was a plan called Abenomics, which was based on three so-called arrows. But the third arrow, structural reform, was honestly the cleverest part. It introduced a new stock index of Japan's 400 best-run companies. The deal was the huge state pension fund would only invest in these firms, and every year the losers who got kicked out were publicly named and shamed. They literally called it the shame index. Okay, so all of this brings us to the final and I think the most powerful twist in our story. Because while the main headline for Japan's stock market has been stagnation for decades, there's been this hidden story of incredible success unfolding right underneath it all. And the secret sauce behind this success is a concept called Kaizen. It basically means continuous improvement. It's this deep-rooted philosophy of quality, of efficiency, and just pure manufacturing excellence that has allowed certain Japanese companies to become the quiet, undisputed champions of their industries. So, here's the deal. While the big, familiar names in the keiryatsu system might have been struggling, Japan is also home to a huge number of smaller, more specialized companies that are absolute world beaters. These are the hidden champions. And you don't have to take my word for it. Just look at this. This chart tells the story beneath the story. See that flat line? That's the broad Nikkei index, languishing for decades. But look at the stock prices of these specialist firms. They're just rocketing upwards, completely disconnected from that bigger, gloomier narrative. And we're not talking about small players here. These are global powerhouses. Fanuc is the world leader in industrial robots. Daikin is totally peerless when it comes to air conditioning. Keynes is a master of factory automation. And Nidec? They make the tiny, high-precision motors that are in basically everything you own. These companies completely defied the odds. So, what's the big lesson in all of this? Well, it's that a flat, stagnant market index just doesn't tell the whole story, not even close. Incredible innovation and real value creation are happening, you just have to know where to look. It proves that true excellence can thrive even in the toughest economic climates. And that leaves us with one final big question to think about. As the rest of the world, Europe, the US, starts to face these same demographic challenges of an aging population, you have to wonder, was Japan's journey over the last 30 years just a cautionary tale of what not to do? Or with its focus on robotics, automation, and these hidden champions, is it actually a roadmap for the future? All right, let's dive right in. Today, we're going to try and make sense of the wild, complicated world of Asian stock markets. And we're going to uncover some of the hidden patterns that connect them in ways you probably never expected. So, to get us started, I want you to picture something. You're in one of those amazing, bustling Singaporean hawker centers. You've got all the smells, the sounds, the sights. It's just electric. Now, what on earth does that have to do with a stock market? Well, it's really tempting to see each stock market in Asia as its own separate little food stall, right? You've got your Hainanese chicken rice over here in Singapore, your Indian curry in Mumbai, your satay in Jakarta. Each one is totally different and doing its own thing. But you know what? That view is missing the real story. The truth is actually much cooler and, yeah, a lot more complex. These markets are all connected by these invisible threads, almost like a giant spider's web. So when there's a little tremor in one part of that web, you better believe those vibrations are felt all across the entire thing. And understanding those threads, that's the key to seeing the whole picture. So in this first section, let's pull back the curtain and really start to uncover what these invisible connections are. Now, in the world of investing, they actually have a name for them: investment styles. An investment style is basically one of those invisible silk fibers. It's just a shared characteristic that makes different markets start moving in similar ways. There are a bunch of these styles, but let's start with the one that's probably the easiest to wrap your head around. And that first invisible thread is simply size. Yep, we're just talking about the size of the companies listed on these markets. It plays this huge role in how markets behave, especially when they're trying to recover from a crash. Think about a typical market recovery cycle. It usually happens in about 3 stages. First, you get what's called revulsion. That's when everyone panics, sells everything, and runs for the hills. Then comes displacement. A few brave souls creep back in, but they're only buying the biggest, safest stuff. And finally, you get expansion. Confidence is back, and the hunt is on for smaller, maybe cheaper companies with more room to grow. So in that second stage, that displacement phase, who are these investors buying? They're buying the giants, the household names. We're talking about companies like Samsung in Korea, TSMC in Taiwan, or Tencent out of Hong Kong. Because these huge, well-known stocks feel like the safest possible bet, you start to see them move together, right, across the region. Okay, our next invisible threat is a little bit more complex, but it's so important. It's this constant tug-of-war between company profits on one side and bond yields on the other. You can pretty much think of bond yields as being tied to interest rates, and believe me, they create a really powerful force in the market. So when bond yields start to climb, you get these really clear winners and losers. On the winning side, banks. They get to lend money out at higher rates, which is great for their profits. And that's fantastic news for markets that have a lot of banks, like Singapore and Thailand. But who loses? Well, think about some hot new tech startup, maybe an EV company. Its value today is all based on the huge profits it hopes to make way down the road. But higher bond yields make that future money worth less today, and so the stock price often takes a hit. Now, size and bond yields are just 2 threads in this really intricate web. There's so many others that connect markets in pretty surprising ways. Things like commodities, exports, and even corporate governance. This table gives you a quick look at a few more. Take commodities. When oil prices shoot up, that helps Thai oil refiners. But it really hurts a big oil importer like India.
See, same event, totally opposite effects, but connected by that one single thread. Or what if investors decide to focus on exports? Well, then tech-heavy markets like Taiwan and Korea suddenly look great. And what about after a big corporate scandal? Well, investors might suddenly prefer the simpler company structures you see in India over those complex, family-owned conglomerates in Korea, the ones they call chaebol. See how it all connects? But here's the thing. These threads, this web, it isn't static. Just when you think you've got it all mapped out, some new force can come along and just shake everything up. And in the last few years, that new force has been the incredible rise of individual investors, what we call retail investors, all across Asia. Maybe they were just bored during lockdowns, who knows? Or maybe it was just how easy it is to use new trading apps, but a whole new generation has jumped into the stock market. The source material even tells the story about two nephews in Jakarta, Anur and Vandi, who are part of this massive, tech-savvy wave of new investors.
And the impact of this new army of investors, it is absolutely staggering. I mean, just look at this. In 2020, retail investors in Korea were responsible for nearly 80% of all trading activity. 80%. It was 60% in Taiwan and 58% in India. This isn't just some small trend. It's a fundamental change in who is actually moving these markets. And if that wasn't enough, get this. In that one single year, 2020, Korean retail investors traded a higher volume of stocks than they had in the entire previous decade combined. Just let that sink in for a second. It's an absolutely incredible statistic, and it just goes to show you how profoundly this web is changing. So let's bring all of this together. We started with these separate little food stalls. We moved to this idea of an interconnected web, and then we saw how new forces are shaking it all up. So what's the big takeaway here? It's this understanding these investment styles, these invisible threads, is the difference between seeing a random collection of lonely food stalls and seeing the entire interconnected web. It lets you understand why markets that seem totally unrelated might suddenly start moving together. And that brings us right back to where we started, at the Hawker Center. As the source material puts it so perfectly, being able to spot the next big change in style, the next thread that's about to start vibrating, it's like being first in line at the best stall in the market. It gives you this huge advantage before the rest of the crowd even knows what's going on. So I'll just leave you with this question to think about. Now that you know how to look for these connections, whether it's company size or bond yields or commodity prices, what invisible thread will you look for next? Thanks for tuning in.
Welcome to The Explainer. Today, we're going to unpack one of the biggest trends in finance, responsible investing. And we're going to do it through the absolutely wild story of Luckin Coffee, the company that tried to take on Starbucks in China, and, well, let's just say it didn't end well. Okay, so let's dive right in. Luckin Coffee was this super ambitious upstart. Their game plan was pretty simple, really. Use a slick app, throw massive discounts at people to get them hooked, and just, worry about profits way, way down the line. It was all about growth, growth, growth.
And for a while, man, it worked like a charm. They had this all-star founding team, tons of investor cash was pouring in, and the growth was just meteoric. Think about it. In just a couple of years, they went from zero to a $12 billion company on the US stock market. Incredible.
I mean, it had all the makings of a classic success story, right? A true market disruptor. But as it turns out, just about everything that could go wrong was about to go very, very wrong.
So, the first domino fell when a well-known U.S. firm that bets against companies, Muddy Waters, came out with a shocking accusation. They said Luckin was, get this, just completely making up its sales numbers.
And guess what? It was true. After denying it, the company did its own investigation and confirmed the fraud. The stock got kicked off the NASDAQ and its value just, poof, evaporated, almost overnight.
$180 million. That was the fine the U.S. Securities and Exchange Commission slapped on Luckin for defrauding investors. A huge penalty for a truly huge deception. Now, the Luckin story is, of course, a pretty scary reminder of how risky it can be to bet on just one company. But it does something more important. It shines a massive spotlight on a concept that is absolutely crucial for any investor: corporate governance.
At the end of the day, when you buy a stock, you're not just buying a piece of a business model. You're putting your trust and your money in the hands of the people running the show. And in Luckin's case, that trust was totally broken.
And this brings us to a fantastic analogy for a very common problem. In many parts of the world, especially in Asia, trying to figure out who really controls a company can be, well, like looking at a tangled bowl of noodles.
You see these really complex setups, things like stock pyramids or hidden family control. It can make it almost impossible to know who's actually pulling the strings. And often, it means their goals aren't the same as yours, the regular investor. That creates a whole lot of risk.
So this whole idea of digging into a company's leadership and its ethics, that brings us to the G, the governance part, of a much bigger trend that's taking over the investing world, ESG.
ESG is basically a framework that helps investors look beyond just the balance sheet. It's about asking bigger questions. What's the company's environmental impact? How does it treat its workers? And, of course, who is running the place? And are they doing it honestly?
And this idea has absolutely exploded. By 2020, over $40 trillion worldwide was invested with ESG principles in mind. To put that in perspective, that's about 40 times the entire value of a company like Apple. It's a tidal wave of money.
But you know, it's funny, this whole ESG thing feels super modern, doesn't it? But the core idea behind it has actually been around for a very, very long time.
I mean, we're talking about ideas on ethical finance that go all the way back to ancient religious texts. You see it in the 18th century with groups like the Quakers refusing to invest in the slave trade. Fast forward to the anti-apartheid movements in the 80s. And more recently, huge wake-up calls like the 2008 financial crisis and the COVID-19 pandemic have just pushed this idea into overdrive.
Okay, so ESG sounds great in theory, right? But, and there's always a but, it's not that simple. The world of responsible investing comes with its own set of pretty big challenges.
A huge problem is just trusting the data. This chart here tells the story perfectly. In China, a massive 85% of top companies put out these ESG reports. Sounds good, right? But look closer. How many of them actually get that report checked by an independent auditor? Just 12%, a tiny fraction.
And beyond unreliable data, the term ESG itself is kind of fuzzy. What one person thinks is good can be totally different for someone else. You even find some so-called green funds that hold companies that, let's just say, don't exactly pass the sniff test. It really means that old saying, buyer beware, is more important than ever.
So with all these problems, what's the bottom line here? Why should you, as an investor, actually care about any of this?
Well, here's the real kicker. Good ESG isn't just about feeling good, it's about smart risk management. There's growing evidence that companies with strong ESG practices are often just plain better-run businesses. They're less likely to get blindsided by the kinds of scandals and lawsuits that can absolutely demolish a stock's price. So ultimately, you should think of ESG as another powerful tool for your investment toolkit. It's a framework that can help you look under the hood and, hopefully, help you steer clear of the next Luckin Coffee, a company that looks amazing on the surface but is completely rotten at its core.
And that's really the big question for the future of investing, isn't it? It's not just about finding the next hot stock, but about really understanding the character of the companies we choose to put our money into. With trillions on the line, can any of us afford not to?
So, how do you predict the future? Do you go with, I don't know, ancient spirits, or do you stick to cold, hard data? Well, in Asia, it turns out it's not always a simple either-or choice. We're about to dive into this really fascinating world where mystical beliefs and, market realities actually collide. Let's see what the next decade might hold.
Okay, so check this out. In Hong Kong, right in front of HSBC's headquarters, you'll find these two iconic bronze lions. Their names are Stephen and Stit. And trust me, they're not just statues. For a lot of people, they're these powerful guardians of wealth. This picture here, it's from all the way back in the 1920s, and it shows this long-standing tradition of patting their paws for a bit of good luck. So get this. In late 2020, the lions had to be restored after some vandalism, and a feng shui master came in, did a ritual, and made this incredibly specific prediction you see here. Now, at the time, HSBC's stock was, well, it was in the gutter. We're talking a 25-year low. But then, and this is the wild part, almost exactly on cue, 49 days later, the stock just shoots up more than 30%. I mean, that's pretty uncanny, right? Look, most of us, we don't exactly have supernatural powers of prediction, right? And that really brings us to these two different worlds of forecasting.
On one side, you've got the spirit world, feng shui, fortune sticks, that kind of thing. And on the other, you have let's call it the more mundane world of market strategists. It's all about hard data, endless spreadsheets, and constantly having to reevaluate everything. And that's the world we're going to dive into today.
All right, so if you want to try and forecast the future, probably the best place to start is by looking back, checking the rearview mirror. So let's do that. Let's see what the last couple of decades can teach us about what's actually worked in Asia.
Whoa. I mean, the numbers on this chart are pretty staggering, aren't they? Think about it. If you had put just $100 in at the start of the millennium, by 2021, that $100 would have ballooned to over $900 in China's market and almost $750 in India. Now compare that to the US S&P 500, just $284. That's a dramatic outperformance, to say the least.
So you got to ask, why did some of these markets do so well? Well, back in 2000, a lot of southeastern markets were still just reeling from the Asian financial crisis. Their economies were, frankly, in tatters. And what does that mean? It means stocks were incredibly cheap. And this points to a really key lesson. Some of the best times to get in are when things look the worst, right after a market crash.
And when you actually drill down and look at the specific companies that really won big, two clear patterns start to pop out. First, you've got these global leaders in a really specific, fast-growing industry. Think of a company like Sunny Optical making those specialized camera lenses for pretty much every smartphone. Then, on the other hand, you have the absolute domestic giants, the unbeatable local champions with these powerful brands, like Tencent and Alibaba in China, or Hindustan Unilever in India.
Okay, so enough looking back. Let's swivel that mirror around and try to look forward. Now, obviously, we can't know everything about what 2030 will look like, but there are some huge kind of tectonic shifts that are actually highly predictable. And the first one, maybe the most powerful of them all, is demographics.
So in China, one of the most important groups you have to watch is what they call the empty nesters. We're talking about middle-aged households whose only child has grown up and, flown the coop. And all of a sudden, bam, they have a lot more money to spend and they're looking for more premium experiences. This is creating a huge boom for things like luxury travel and private healthcare.
And the scale of this, it's just massive. I mean, back in 2020, this group in China was only about a third of the size of the same group in the US. By 2030, they're going to be larger. This isn't just some boring statistic, this is a fundamental shift in global spending power. It's like a fast-growing army of super consumers, and they're all looking to upgrade their lifestyle.
Here's another demographic trend for you. Urbanization, but with a twist. See, people aren't just flocking to the mega cities like Shanghai anymore. No, the real action is shifting to these mid-sized cities. And look at this number. Their count is set to basically explode, hitting 330 by 2030. These places are becoming the new hotspots for everything. E-commerce hubs, specialized manufacturing, you name it.
All right, that brings us to our second big, predictable tectonic shift. And that's the intense and frankly escalating rivalry between the US and China. But this fight, it isn't being fought with tanks and planes on traditional battlefields. Nope, it's being fought over technology.
And right at the very heart of this whole struggle, semiconductors. We're talking about those microscopic computer chips that are basically the brains behind everything in our modern world. Your phone, your car, even advanced military gear. So the point is this, and it's a crucial one. Whoever controls the chips, they hold an immense amount of power. Now, Asia plays an absolutely central role in this whole semiconductor game. You've got giants like Samsung in Korea. They design and make their own chips. But then you have a company like TSMC in Taiwan, which is a foundry. They only make chips that other companies design. So you can see from this, it's a really complex supply chain, and it really highlights just how reliant China is on its neighbors for the high-end chips it so desperately needs.
And this dependency, it's sparking this huge push for what everyone is calling self-reliance all across the region. Of course, China is pouring billions into trying to build its own chip industry, but it doesn't stop there. They're also investing massive amounts in renewables and electric vehicles. And at the same time, you've got India focusing on building up its own pharmaceutical industry so it's less reliant on imports from other countries.
Okay, so we've got all these massive trends swirling around, right? Demographics, this huge tech rivalry, the push for self-reliance. I mean, how do you even begin to make sense of it all? Well, the answer might just lie in a really simple lesson from way back in the 1848 California gold rush.
So you know the story. Gold is discovered and hundreds of thousands of people rush into California, all hoping to strike it rich. But what happened to most of them? They just found backbreaking work and not much else. The real winner, though, was this one guy,
Samuel Brannan. He never dug for a single ounce of gold himself. Instead, he just sold the picks, the shovels, and the pans to all those hopeful miners. And guess what? He became the first millionaire of the gold rush.
So the moral of the story is pretty simple, right? In a gold rush, you don't dig for gold, you sell the picks and shovels. And this idea applies perfectly to today. Think about it. Instead of trying to bet on which single electric vehicle brand is going to win the big race, maybe it's smarter to look at the companies making the essential battery components that go into all of them. The same logic works for clean energy parts or for the cloud computing services that power basically every hot new app out there.
So let's put it all together. Here's your toolkit for thinking about the next decade. First, remember that demographics are destiny, so follow those trends in aging, urbanization, and new consumers. Second, understand that this tech rivalry is going to create some very clear winners and losers. Third, learn from history and focus on market leaders. And most importantly, always remember that lesson from the gold rush. Don't just pan for gold, sell the picks and shovels.
Look, these huge shifts we've talked about, they aren't just abstract ideas on a slide. They're creating massive new opportunities, like right now as we speak. So the real question I want to leave you with is this. As you look at the world changing all around you, where are you going to find the picks and shovels?